Why Bitcoin just broke 100K and how you can ride it safely. Bitcoin smashed records. Here's how the smart money is acting right now. Opening, context, and impact. Here's the deal. Bitcoin just broke the six-figure barrier again, and this time it's not a fluke. May 8th, 2025, BTC reclaimed 100K and held above it. Dominance over altcoins surged past 60%, signaling serious bullish sentiment and revived hopes in markets all around. Why this happened? Macroeconomic factors. The combination of falling bond yields, a weaker dollar, and institutional inflows into Bitcoin ETFs fueled this rally. Furthermore, the rumor and then the fact of a trade deal between the US and the UK was the trigger that pushed BTC above $100,000. On-chain and large investor shares, the inflow-outflow ratio fell to 0.9. This indicates accumulation, not selling. It gives a clear signal that investors are holding on. What's more, approximately 19,400 BTC that had been sitting idle for 3 to 7 years migrated to institutional portfolios. You can smell the long-term strategy. Technical, sign of strength or trap. Look at the technical analysis. Bitcoin has risen more than 30% since April, with almost no corrections, hitting 3 impulsive waves. This is a typical case of being in the middle of a wave, with a correction in sight. The RSI is overbought, and the MACD shows signs of bearish divergence. In other words, be careful. A short-term correction may be coming. But on the weekly chart, there's still fuel. There's a debate between a final rally or a cycle top. How the smart money is acting? Simple. They're not panicking. On the contrary, they're calmly accumulating. Institutional inflows into ETFs remain steady, with billions flowing week after week. It's that game of patience. Fewer selling, many are holding, while the price remains above the psychological mark. And this reinforces $100,000 wasn't just a flash in the pan. It could be a real stepping stone in this bull cycle. What you should do: ride it safely. Rule number 1. Don't put everything in BTC. Be realistic. Only use a portion of your portfolio if you're comfortable with risk. Rule number 2, think long term. If your intention is to accumulate, maintain discipline and ignore the daily noise. Rule number 3, use gradual entry strategies. DCA, dollar cost averaging, is your best friend for gradually entering and reducing the risk of buying at a high. Rule number 4, protect your gains. Consider stop losses, take profits gradually, or reallocate part of your portfolio to more stable assets if you want to sleep easy. Rule number 5, be humble. The market can turn quickly. Be ready to adjust your strategy based on macroeconomic and regulatory events. What the big guys are doing now. I've already talked about accumulation. But now look at the big guys' movements. Old money wallets, those that have been holding BTC for years, were sleeping on the couch. Now they're awake. They started moving when the price broke $100,000. People might think Captain Greed, but it's actually a strategy. Shifting assets they've held for 3 to 5 years to invest in infrastructure, NFTs, and DeFi. This flow shows that 100,000 was seen as a transition point, a green light to reallocate capital. Quick joke. In other words, if those guys who were camped out before the wave have woken up, it's time to really pay attention. Comparison with previous cycles. Zoom out. 2017, 2021, 2025, the pattern repeats. After picking up speed, there's a peak, a dip, and then an even higher climb. In 2017, after its ATH, Bitcoin plummeted 35% in weeks. In 2021, after hitting $60,000, we saw a 45% correction before exploding to the top. If 100,000 is that point, we could see a slight stop before continuing. But you can't count on this script every time. Each cycle has its mark. Take a joke. It's like that ant who tries to repeat the cake recipe from the last decade. Sometimes it turns out exactly the same, sometimes a disaster. Be careful. Risks that could change the game. Okay, it's going up, but nothing is bulletproof. Let's look at the concrete risks. Authoritarian regulation. If a large country like the US or EU tightens its grip, it could put the brakes on. Systemic bank failure or dry liquidity, as in 2023, shrinking banks could pull liquidity to the bottom. Macro shocks like war, energy crises, etc., which turn the spotlight on what really matters: food and fuel, not cryptocurrencies. But look at the smart side. Diversifying, hedging with stablecoins, or even digital gold via large funds can cushion these impacts. Bold observation. This isn't panic mongering, it's smart money playing it safe. You can too. Target opportunities and exit points. Okay, you want to ride, but where to stop? Smart money is already operating with clear targets. Key levels to watch: 110K to 115K, possible short-term resistance zone; 120K to 130K, partial profit target for many; 140K to 100 50K moonshot if institutional flow doesn't tire. Practical strategy, sell a little at each level. If it explodes, great. If a correction comes, you've already pocketed part of the profit. Final observation, little bird. Think of Bitcoin like that party that's going strong. It's nice to stay until the end. Altcoins in the domino effect. Visual, chart showing BTC dominance rising, altcoins falling, and then some trying to catch up. Whenever Bitcoin explodes, altcoins struggle a bit initially. BTC dominance has already surpassed 60%. Meaning money is concentrated in the market father. But be careful, historically, after BTC stabilizes, the famous altcoin season begins. This is when smaller tokens begin to soar as investors seek to multiply their gains. But then it's high risk, high reward. Think of it this way. Bitcoin is that crowded bus everyone gets on. Altcoins are the motorcycle taxis without helmets. The trip can be quick, or it can leave you stranded. Mindset of the surviving investor. What really separates those who win in the long run from those who disappear? Mindset. The surviving investor understands three things. Corrections are normal. A 20% drop isn't the end of the world in this market. Discipline greater than emotion. It's not about hitting the top or bottom. It's about consistency. Long-term vision. Anyone who believed in BTC at $3,000, $30,000, or $60,000 today is not complaining at $100,000. Punchline, want a secret? The market always tests your patience before rewarding your strategy. The role of Bitcoin ETFs. The big difference between this cycle and previous ones, approved Bitcoin ETFs. This changes everything. Before, the average investor couldn't put BTC in their retirement portfolio. Now, any fund can pour billions into their portfolio without ever touching a private key. In 2025 alone, ETFs have already absorbed billions of dollars in net inflows. This is institutional fuel, and it keeps the price from plummeting at the first hit. Quick humor. It's like when your grandmother discovers iFood. She won't stop using it, and this generates a constant flow. Halving and program scarcity. Another reason why $100,000 may be just the beginning is the halving. Every 4 years, the miner's reward is cut in half. This means less new Bitcoin entering the market and a more limited supply as demand explodes. Historically, after each halving, Bitcoin soared in the following 12 to 18 months. 2012, 2016, 2020, and now 2024, 2025 could repeat the pattern. Acidic joke. It's almost like free beer at a college party. When it starts to run out, everyone rushes to get the last can. The psychology of crowds. Never underestimate the power of collective psychology. $100,000 isn't just a number, it's a symbol. For the average investor, it's the seal of approval that says, this is real. The media will hammer home the headline, friends will talk about it at barbecues, and new entrants will enter the market with total FOMO. But here's the lesson. The veterans were already buying quietly months ago when everyone was saying Bitcoin is dead. Irish punchline. Smart money buys into boredom. Retail buys into hype. Which of these two do you want to be? Geopolitics and Bitcoin. Visual. A world map with flags and BTC icons circling. The price of Bitcoin isn't just rising because of the charts. There's geopolitics at play. Countries experiencing currency crises like Argentina, Turkey, and Nigeria are using BTC as a safe haven. Every time local currency loses value, demand for Bitcoin skyrockets. What's more, governments like El Salvador continue to hoard BTC as a strategic reserve. This creates a snowball effect globally. Quick humor. It's almost like free Wi-Fi. Once someone finds it, everyone wants the password. The future. Where does it go after $100,000? The billion-dollar question. And now, after $100,000, what's the next target? The most optimistic models predict $200,000 by the end of the cycle.
From 2020 to 2024, it became a speculative asset compared to digital gold. Now, above $100,000, the narrative of the next decade is different. Bitcoin as global financial infrastructure. The debate stops being will this die and becomes how will governments and banks adapt to this? And guess what? Narratives move capital long before fundamentals. If you understand the story being told, you're already ahead.
Conservatives see something around 120,000 to 150,000. The truth is, no one knows. But one thing is certain. If BTC remains above 6 figures with institutional support, it will enter a new phase, not only as a speculative asset, but as a solid investment class. Punchline, so don't ask how far it will go, ask how long can I hold it without losing my mind. Bottom line, Bitcoin crossed 100K again on merit, structural strength, and institutional support behind it. But here's the important thing. If you want to ride this wave without breaking your bank, be strategic, disciplined, and conscious. Subscribe to this channel, like its comments, leave down below here your own comments, and start your journey to financial freedom.